All right, welcome to chapter 23, the first lecture video of this section. Now we're getting into some really good stuff. This is the stuff that I think it's exciting, and it's how do we use different performance measures to motivate our employees, to align our firm goals with the goals of our employees. So that's going to be what we're going to go over in this chapter. And in this first lecture video, we're just going to kind of do an overview, and then we'll get into one performance measure that you guys are definitely familiar with, and that's ROI, or the return on investment. So let's jump in and start discussing how do we use performance measures to motivate our employees. So what makes a performance measure well suited to assess performance? Well, it has to be sensitive to or change significantly with the manager's performance. And what this means is we want to choose a measure that the manager essentially has control over. So this manager, they're the person we're trying to incentivize, get them to work hard, but they need to know, and it has to be true, that if the manager works really, really hard, the performance measure should go up. If the manager totally slacks off and doesn't work at all, the performance measure should go down. Because think, would you want your bonus tied to something that you really can influence through effort? Or do you want it tied to something that's just totally random and all these things out of your control will decide how much your bonus is? Of course, we all want our own effort to be able to influence our outcomes. So a good performance measure makes sure that the manager's decisions and effort really can influence the end performance. And then the opposite of that is we should try to minimize the impact that things outside the manager's control can influence that performance measure. We don't want other division managers' decisions. Remember, we've learned this in past classes. We don't want other managers' decisions to influence a different manager's bonus. We don't want to have somebody else control someone's bonus. So, really, we want a performance measure that is largely influenceable by the manager and minimizes things from the outside or external things that can influence the performance measure. In general, we just want to find a performance measure that motivates our managers because they know that their effort is the main driver, or their decisions are the main drivers of that performance measure. So, kind of along the same lines, what are some goals? Well, we want to motivate our employees, our managers, and really the goal is just to align their motives with that of top managers. So, the actions that increase a performance measure should also be the actions that top management that they want the manager to take. Should provide an incentive, and this is big, that we want it so they can do this autonomously. We don't want the top executives to always have to be monitoring or trying to figure out a way to monitor the managers. We want an incentive or a performance measure out there that kind of does the monitoring for us. That we know if they really are giving high effort and making good decisions, they should get this bonus. If they're not making those good decisions, then they shouldn't get this bonus. And then this is the big one is we want it to be fair. We want them to get rewarded for making good decisions and providing high effort. We never, ever, ever want our employees to feel that the compensation system is unfair. Not only is that terrible for morale and will likely get decreased performance and poor decision making, but in general, we always want to be fair and responsible to our employees. So we want to pick performance measures that really are fair and help our employees while simultaneously helping our firm. So there's a lot of different performance measures that are out there, but for this lecture series, we're going to focus on three big ones: ROI, RI, residual income, and EVA. So EVA, this is kind of the newer one. It's gaining popularity, and we'll go over that. but you guys should be familiar with at least these two. We'll dive into the calculations, but we're not going to go real in depth on these because hopefully you guys have had pretty significant experience in other accounting or finance classes looking at these performance measures. So ROI, return on investment. Really pretty simple. It's your income divided by investment. And the reason why this is so popular is because it kind of incorporates all the different decisions a manager can make. So decisions regarding revenues, costs, and investments, the assets that manager decides to purchase to try to increase revenues or decrease costs. And it puts all these things in one single metric. And since everybody does ROIs and ROIs can be easily calculated, that it makes it very comparable how your manager or this division or your company, how they stack up against other managers, other divisions, or other companies. Since everybody calculates it, and if they don't, we can go to the 10Ks or go obtain some information and we can calculate it for comparison reasons. So that's why it's so popular. It has all aspects of accounting and it's very comparable. So we don't want to stop at just the high level ROI. What we want to do is break it down looking at the DuPont method, which says this here is the main ROI calculation, but let's separate the numerator and denominator here, and let's add sales value as the denominator under income, and add sales value as the numerator over invested capital. So as you can see, these two would cancel out, and we'd get back to our same original function. But by breaking this down, we actually get more information from how our managers performed. And we can break this down for our managers to show them, hey, this is really how you can influence this return on investment performance measure. So this first piece here, this is essentially the return on sales. So it's income divided by sales revenue. And this comes out to a percentage, and it says what percentage of your income or what percentage of your sales revenue survive to income. So your goal is to get this percentage as high as possible, meaning that when you have your sales revenue, a higher percentage of that sales revenue is still there after you take out all your costs and get to income. The next part of this equation is your investment turnover. So it's sales revenue divided by invested capital. And this says, how well did you use your invested capital? How well did you utilize those assets? And this just says how many dollars of sales revenue come out of every dollar of assets that you have invested. And hopefully this is a really high number. If it's, say, $5 or comes out to 5, that means you obtain $5 of sales revenue for every $1 that you've invested in your assets. So both of these can be broken down, and like I said, it can really help managers understand how they can influence this performance metric. So let's do a real quick example. So here we go. This is the current, we're a retail division. This is your current ROI. Your sales margin is 5%. Your capital turnover is 2. So this means that 5% of your sales revenue makes it all the way down to net income. So about 95% comes out in costs. Capital turnover, this means that for every dollar that you have invested in assets, you're making about $2 in sales revenue. And that comes out to equal an ROI of 10%. So we can tell the manager, well, one way to influence or improve your ROI and increase it, say, to 14% is to increase your sales margin. And we can break that down further and say, well, the way you increase your sales margin is we can increase our sales price, or we can cut expense to make more of our income survive from the sales line item. Similarly, we have the same information up here, and we can say, well, if you can't really influence your sales margin, you can also increase your capital turnover, and that will increase your ROI of your division. So when we can do this is, again, we can increase our sales price to get our sales revenue higher, or we can decrease the assets that we've invested. And this means, hey, maybe you're trying to get your manager to be more efficient. Do we need all these assets? Do you have machinery that is just sitting there idle that we can get rid of and increase our ROI? So again, this method of breaking the ROI into two separate performance metrics is just useful in after the fact, looking at our manager's performance and seeing was it good or bad because of sales margin or capital turnover. And we can help lead or guide our managers by showing them a breakdown of ROI and the different ways they can influence their performance. So, a couple things that we want to talk about when you're computing ROI is, since it uses assets in the computation, we want to make sure that only assets controllable by that unit or that manager are included in this ROI computation, right? We don't want all the firm's assets in this computation because that manager isn't making the decision of all the firm's assets. They're not using all the firm's assets to create the value in their division. So we really want to limit this computation to only the assets under that manager or that unit's or that division's control. And then how do we value those assets? Well, there's four different ways to do it. We can look at gross book value. So this is kind of the historical purchase price that's on the books. The good thing is it's very objective, but it can really differ by a division's age. So if one division bought their assets 20 years ago, or let's say 5 years ago, and say they have a value of $10. But our new division bought their assets this year after the price of steel went way up. So they have the exact same assets, but when you buy them this year, they cost a lot more than they did those historic for our other division. So it could really differ by the division's age. So you're not really comparing apples to apples. Net book value, it's consistent with what we see on the balance sheet, so that's good. But it's not always objective. There's a lot of different ways that managers can essentially not manipulate, but can change the book value. Different depreciation methods that we've learned about in our other accounting classes, write-offs. There's a lot of different ways they can change this value. Current cost. This is probably the best. If possible, we would love to use current cost because it says, hey, what is the current value of those assets? And that way we're really comparing apples to apples across divisions. We're saying all the true value, the market-based value of your assets today across all divisions. That's what you're using, so how are you performing with those assets? The bad part about this is they can often be pretty hard to obtain, and it might not be worth it having an appraiser come out and value all your assets across your whole firm every couple of years. That might end up being a huge expense and not quite worth it just to build into these computations. Now, the last one is liquidation value, and it's just saying, hey, if we needed to liquidate these at current period or right now, how much money could we get from them? That one is not particularly useful. It does have some downsides, but if your gross and net book value didn't really make sense, your current cost wasn't obtainable, then liquidation value would be a pretty good alternative. So some of the advantages and limitations of ROI. One is it's easily understood by managers. Everybody that's been in business has went through a business program. They all understand ROI. It's very comparable to interest rates and rates of alternative investments. So if your cost of capital is 5%, that's the cost of the debt, say you're paying to the bank, you know that you want your ROI to be over 5%. And like we said, everybody calculates these, so it's really easy to find this information for other alternatives or other comparisons. And so the limitation is actually a surprisingly large limitation, and that's that there's goal congruency issues. Um, and this is incentive for high ROI units to invest in projects with other higher ROIs and to forego lower ROIs. And so let's dig into this a little more. And let's imagine we are a division that, this is our division. We're division one, and our current ROI is awesome. We're at 15%. And that's what all of our bonuses are off of. So for every percentage point, say 1 percentage point increase or decrease, our bonus will change by $5,000. Right, so here with 15%, we're making $75,000 in bonus. We're doing awesome. And us as a division, we learn about a new project that has an ROI of, say, 10%. Well, it's a positive ROI, so it's a positive return on investment. So the firm, and it's at 10%, so that's really high. So the firm would really want us to take on this project. If they knew about this potential project, they would want us to move forward with it. But look what this would do to our division's ROI. We're currently at 15%, so if we take on another project that's at 10%, our average ROI would go down. For instance, let's say that these are equal. We're currently, our ROI with $5 million of assets is at 15%, and this project could require another $5 million of assets, and that's at 10%. So if we did this project, we would have $10 million of assets, and our ROI would drop to 12.5%. Uh-oh, we're going to lose out on over $10,000 of bonus. So even though the company would say, heck yeah, you should do that project because it would make the firm a lot of money, the fact that it would decrease our division's ROI would make it so maybe people would say, ooh, let's not tell the firm about this project. Let's just forgo it. We'll focus and we'll try to find projects that are above 15%. So in general, ROI can be problematic as a performance measure because sometimes the projects that are good for the firm aren't necessarily good for the division manager or the division that's using ROI. So we could get to some projects being foregone that should have been taken or should have been moved forward with. So here's a practice problem for you guys, Performance Auto Company, and it says, hey, here's a lot of information for two divisions. Go ahead and calculate the ROI for each division. And we're going to see this problem come up again as we move forward with the other performance metrics. And as always, the answer or the solution to this problem, please work through it, try your best, and then compare to the solution that will be posted in the slides. So that's it for today, or for this lecture. We've done an overview of performance measurement, the goal of performance measurement, what we look for in a performance measure, and then we just started looking at performance measures by learning a bit about ROI. The next lecture, we're going to continue looking at performance metrics, and we're going to look at residual income and a specific form of residual income called economic value added. Yep, so we'll see you in the next lecture.